and welcome to this edition of ADIPEC Energy Dialogues, a series of conversations with leading analysts and experts from around the world in the run-up to ADIPEC. I'm Etna Traynor, your host for this session, and I'm absolutely delighted to welcome here today the Managing Director and the Global Head of Commodities Research for Citi. Please welcome Ed Morse. Ed, thank you so much for joining us.
And thanks for inviting me. Good to see you.
Indeed, great to see you. It's been a while, and it's lovely to have you here on this virtual interview. We look forward to seeing you in person very soon. Now, when we look back on the oil market, and I think we really have to do this first, look back on the last few months and really look at the impact that COVID-19 has had. I know in light of the reports that you have been doing, your long-term report and all of the work you're doing around this, come back and just bring us up to date in terms of what has the impact for COVID-19 been on the energy sector?
Well, it's been devastating. It's hard to know what word to use because no matter what word you use, you can't get to how awful it has been. Whether you're a producing country or a producing company, it has really been a disaster. It's been a setback that will not see a recovery for a very, very long period of time. So I'm happy to talk to all aspects of that, but it's really, truly devastating.
Now, of course, that demand drop that we saw was really the biggest in the history. It was a huge shock, as you said, the word devastating. How can any sector recover from such a steep shock?
Well, normally we see recoveries. We normally see recoveries that go back to where the trend line of growth has been before whatever the interruption has been. And this time, I think it's going to be different. I think we're not going to go back to the old trend line. I think we're going to see very much a 2-year disaster for the world of oil and gas, 2 years of lost demand that won't get back to 2019 levels until late 2021 or even 2022, and never get back to the old trend line of the past.
Wow, now that's quite a cautionary tale to be putting out there at the beginning of this interview. Let's see how we go. And I did want to talk to you about the long-term outlook. We will talk about that. But let's have a look in the near term. And here we are starting the third quarter of the year, the second half of the year. How do you think things are looking, and particularly, when we're looking at demand, whatever bit of demand will come back, particularly now in the third and fourth quarter of 2020?
So we think that things are going to look pretty rosy compared to where they have been. And we think the worst is really over. The worst was probably the month of April and into the month of May. The worst was characterized by a record amount of inventory building around the world. We reckon that maybe 1 billion barrels worth of inventory accumulated during that period of time. We're seeing the very tail end of that inventory build. It may be that we are right at this moment at the transition between the inventory build and the inventory draw. And the inventory draw has already been anticipated by the market. So we have this sign or symbol in the market on the forward curve, and I know it's a little bit technical for some people who are not familiar with the forward curve, but normally when you have an oversupply and an inventory build, future prices look a lot higher than prompt prices. We call that a contango. The level of the discount of the prompt to the futures was at a record level in the month of April. The market has already seen that flattening out. The difference between the first and the second month is already pretty flat, which is an indication that two things have happened. One, supply has been constrained around the world, some of it voluntary, some of it very involuntary, and demand is starting to pick up. So we're seeing the sign of a transition. We're right at the beginning of a transitional period from the worst to something that's going to be better.
I've always loved that word in the oil sector. I think it was one of my favorite words, contango, indeed. So this is what we're happier with at the moment. But talk to me about the situation and how this is going to play out for OPEC and friends, OPEC plus, so to speak. Now, I think it's more than it's about 20 years since we've met at many, many OPEC meetings when we met in the beginning, and you've watched this organization change and manage various situations and scenarios of crisis over the years when they've had to deal with whatever has come their way. This was certainly unexpected. But do you think the strength that has been there with the OPEC plus union, so to speak, has that actually helped them in this time?
Yes, and we should remember that when this started, there was a fragility to the OPEC Plus group, and they were at a market share battle with one another. induced by events at the OPEC meeting in March. But the solidity with which they're acting now is a function of the mess that the world is in. And the world includes producing countries, including the major ones, and that would include the United States. So what the producers really realize, and this is the heart of their cooperation, is that they're all in this together. They are interdependent in a way they never thought they were interdependent. And they have this incredibly shared mutual vulnerability to what was the biggest demand shock in the history of the world. And they know that this is by no means over. They know that there are two things that make the future uncertain. One is the duration of and the extent of the pandemic. And the other is the recession that's associated with it. How do you get out of it? They know that to get out of it, they need recovery from both the United States and China and a recovery in global trade. So I think there is durability to the relationship based on this really acute shared mutual vulnerability that they saw themselves go through in the months of April, May, and into June when things started to look up. They have another problem, which is the perennial problem, the free rider problem, as we call it, in OPEC or OPEC Plus. The guys who don't want to go along, they're not compliant. We sometimes call them cheaters. And they think that they can do better than agreeing to their quota. So we have to look at what they're going to do. And the Saudis have used their spare capacity instrument to a very acute extent this year. And we'll see the degree to which they can keep up the credibility of reminding other producers that if they don't cooperate, the Saudis might not cooperate and the price of oil will go down again.
Yes, indeed. And I think the Saudis have been introducing stricter discipline without a doubt here, even though some countries may argue that, they're in a tougher position whereby it's harder for them to actually comply because they're absolutely dependent. But I think in this, situation, they have agreed they're all in this together. And I think we're beginning to see at least the willingness to comply. We saw that certainly at the last meeting, and that's what we're hearing from all of them. So let's hope that that remains the way. But coming back to, the situation a few months ago too, I think everybody was rather surprised to see the level of support that the US brought into this sort of trinity of key players, Saudi Arabia, Russia, and the US really coming together to make sure that they were all looking after their own interests. This was pretty unprecedented, really, given that it wasn't too long ago when we had the president of the US perhaps not so favorable about what OPEC was up to.
Yeah, so the U.S. position is really based on the very large part of the U.S. economy that is the energy sector, the degree to which the energy sector is important to the economy. The energy sector was among all sectors of the economy, either number one or number two in job creation for the last 5 years. Job creation is particularly important in the U.S. as it is in other petrostates. The U.S. is important to the other countries. The U.S. has had the fastest growth of any oil-producing country in the history of the world, and a lot of OPEC Plus was based at its origins on an assumption that they needed to band together to create a price at which they could survive and the U.S. would see production shrinking. And they've learned that the cost curve of the world as a whole has been significantly influenced by the cost curve in the U.S. And that the U.S. can grow production at $50 a barrel. So that part of the interdependence may be a realization that the hope for a $70 world may never happen again. And that if it happens, it will be short-lived, as it has been in the past few years.
Now we're here at the halfway point almost of the year, and we're looking at prices stabilizing almost for the moment at around the 40s. But this is not good enough for the shale market. And just as you said there, it's really looking at 50. But how does this fare for the shale production in the U.S. right now when we are seemingly almost range-bound around 40?
So we have to think of it being range-bound for a couple of weeks, not if we look at it in terms of the last month. So, there's been a $10 increase in the price of oil over the last month. When we look at the U.S. and we look at the shale sector, I would use the same transitional note or word that I used when I talked about the market moving from a position of an inventory build to an inventory draw. The U.S. oil sector is right at that inflection point as well. We've seen drilling activity collapsing. There were some 680 oil-directed rigs at work at the beginning of the year. There are less than 200 now. We had 1 week in the last couple where the rig count went up. We think the rig count's going to start to go up. We're going to see a resumption in drilling. We're going to see some of the shut-in production coming back. We'll probably see a little bit of a bump up in U.S. production, but then there'll be a continued slide because this, after all, is very high decline rates of initial production. And we don't think the U.S. is going to hit the bottom until sometime next year. The EIA, the Energy Information Administration, has the bottom coming at the end of Q1 of 2021 when they predict production will grow. We're a little later than that. We don't think production will grow again until the end of the second quarter. There are a bunch of uncertainties about that, but we think that the price is not one of those uncertainties. We are of the view that as we see inventory draws week on week, we're going to see the price go up. So we think by the time we get to September, we'll be on a firmer path upward, and we should be seeing $55 Brent by the end of the year. By the time we get to that time, $55 Brent is $51 WTI, and we'll see drilling activity starting to resume again. When it gets back to a level that can increase production, won't be until sometime in the middle of next year. So we're optimistic from a producer perspective about where the price will be, but I think there'll be some bumps in the road before we get to a further solid path upward.
I can well imagine. I'm sure there's plenty of bumps and challenges to come, but you're quite optimistic there, and I'm sure the producers are very happy to be listening to your report from Citi. $55 Brent by the end of the year and 51 for WTI. So I think everybody will be, for them, it will be happily received without a doubt, I'm sure. But talk to me about that U.S. production, and we're looking at what, about 11 million barrels a day right now in terms of production, according to the EIA report. But we're also beginning to see some bankruptcies and mergers and some of the smaller players being bought out of the market. Will this make a difference in U.S. production, or are they just being bought out by the bigger players? So the amount of oil will still actually be the same when the good times come back, so to speak.
Yeah, so there's an optical illusion in the drilling rate, and it's easy to look at and explain. At the beginning of the year, when we had the 680 oil-directed rigs at work, at the beginning of the year, 45% of those were used by private equity-sponsored companies that had 1, 2, or 3 rigs each. And at the beginning of the summer, where the rig count is now under 200, we have, from the private equity-sponsored side, less than 20%. Rather than 45%. So there really has been, in the collapse, a mini collapse of companies that should, to a significant degree, never have been brought into existence, never have been producing at the level they were producing. And we're going to therefore see, when we get back to an equilibrium point, fewer companies. We're going to see less drilling that wasn't warranted. And we'll see a resumption in drilling by the healthy companies, the majors to be sure, and the dozen and a half large cap independent companies that we really think can increase drilling at under $50 a barrel. So we think rather than seeing U.S. production resuming at 1.5 million barrel a day growth, it's going to be at a lower number. That lower number, in our mind, by the way, is dependent upon who wins the election in November more than on any other factor. So it's another big uncertainty on the horizon as to whether President Trump gets reelected or whether Joe Biden, the vice president, former vice president, becomes the new president and puts in play what we call elements of the so-called Green New Deal.
That's what I was just going to ask you as well later on that, but we may as well look at it now when we're looking at it here. I mean, and the likelihood, it's obviously 50-50, and anything can happen from now until November, despite what the polls might say today. They might well say something different tomorrow or next week. But, the big difference that will be there, I mean, is there, first of all, a danger that we're going to see a tighter oil market? And then, are we actually, going to see perhaps a new regulatory environment, a new policy environment in the US in the event that the Democrats get into power?
Yeah, I think there are a couple of things that are pretty certain, given what the vice president has said already, and what looks to be in the Democratic Party platform. So, no doubt, we now have a real-time event this week with the Dakota Access Pipeline having been told to shut the operations down by August 5th by a court that claimed that the Trump administration did not do an adequate set of environmental analysis of what the dangers of that pipeline might be. And to do a new analysis will not be done until 2021, when there will be perhaps another president. And it was President Obama who vetoed the DAPL pipeline, and Vice President Biden said he would have vetoed it as well. So that remains an uncertainty. There's uncertainty on two Canadian pipelines coming from Canada. The president has authority to say no to any international pipeline coming into the U.S. And the vice president has also indicated that he would limit exploration and production on federal lands. What is there and going on in federal lands or federal waters has to be grandfathered by law. But going forward, we're going to see states like Texas that don't need the okay on a federal pipeline, because it's not an interstate pipeline, continue to see production growth. So I think the production growth will largely be based on existing areas of production with pipeline access to export markets.
Now, when you look at the international oil companies and look at producers around the world, we've all talked, and indeed many big conferences over the years have been titled the energy transition. Are you encouraged at all that the oil companies are ready for this, and are they doing enough, and are they doing it soon enough? Because there are also just general environmental policies that are coming on board too that they really have to be adhering to. Do you think they're doing enough to make sure that they're almost transitioning and being prepared and being well on the way within this energy transition?
Well, actually, I think of this as more of what the government-corporate relationship is. I think it's quite clear that the major problem of the hydrocarbon sector is the word carbon. And we need to move, the world is recognized as needing to move to a position of a greater carbon neutrality. For a producer of carbon, they need a market that provides a price at which carbon can be sequestered, at which carbon can be reutilized in a more productive way. So to get to carbon capture, sequestration, utilization, and a productivity of that carbon, we need a price. And to have a price, we need a government. I'm hopeful that pragmatically there can be cooperation so that what government should be doing, namely creating the carbon pricing framework, will be done. That will provide the right kind of incentives for large international oil companies to be able to do what they should be doing, namely getting rid of the carbon.
And again, I think a conversation that has been going on a while, and everybody will welcome this, but it probably needs a bit more pressure to make sure that they come up with a decision on this sooner rather than later, because I think it's something the industry has been crying out for. Let's talk storage, because for quite a while the headlines were all about tank tops, and this seems to have now moved on a little bit. And you're saying that U.S. inventories, even though they were rather high, and they're still high, I mean, they're not near the 5-year average, but you're actually saying now we're really seeing a bit of decline in this. And but is this a sustained decline, you think, for the next few months as the economy opens up?
So I think it's a sustained decline for the United States, for Japan, for the world as a whole. And let's look at the issues that are there. And I may get back to the bumps in the road on these issues. The U.S. is really two countries. we have a seaborne market country, and we have a market that is internal, that is not related to the coast. The inventory at Cushing, Oklahoma, which is not a seaborne market, but an internal market, has seen inventories decline. That inventory decline has been a function over the last month plus of two factors. One is a reduction of production in the interior of the United States. You mentioned the EIA indicating that as of a week ago, the U.S. was producing 11 million barrels a day. We should remember the U.S. was producing almost 13 million barrels a day in the middle of the winter. So that 2 million barrels a day of lost production is largely in the internal market. And in that internal market, we're seeing refineries coming back online. They're not anywhere near where they should be seasonally, but given where they were at a 60+% utilization rate, now above a 70% utilization rate, that has also helped to draw down the inventory. We also have a coastal market. That coastal market is like the Chinese coastal market and other coastal markets that have seen an armada of ships coming in. So the inventory build in the US has been on the coast, in the coast of California and the coast of Texas, Louisiana. We are now seeing that level of tankers coming into the US reaching a much lower level. And the sign was actually more than a week ago, where we went from 1 week where Saudi imports were 1.5 million barrels a day, and the next week they were 400,000 barrels a day. So all of that excess Saudi production from March and April has come to an end. We're seeing it eventually in China, and this is part of the bumpy road ahead. China still has an armada of ships that are discharging oil. Some people think that if all the oil outside of China could be discharged at once, it would be 14 million barrels a day of imports rather than 12 million barrels a day of imports. We're going to see a drop of imports of over 2 million barrels a day coming to China sometime soon. That will move them from an inventory build to an inventory draw situation as well. So yeah, I think we're not any longer talking about tank tops, but we're talking about an end to when this extraordinary inventory build is going to be on the horizon. It is right on the horizon right now.
And also, I mean, in your report, talk to me about the light sweet and the heavy sour crude differentials in terms of who's buying what and, you know, who can meet the supply.
Well, we see because of the OPEC plus cuts, which are mostly sour crudes, that there was a collapse in the differentials, and we even saw for a period of time Urals pricing above Brent sour crude in Europe at a lower gravity pricing above a light crude. There's also demand for light sweet crude in the world, and let's look at what the demand slate is. So this is going to be a big problem or a puzzle for the oil industry going forward. The three largest areas of product demand growth were, first of all, petrochemical feedstock demand like naphtha, propane, and pentane pluses and the like coming out of either the refinery pool or the condensate or natural gas liquid pool, jet fuel, and gasoline. We've seen growth in only those three product lines. Not much growth in middle distillates other than jet fuel, negative growth in the heavy end of the barrel. We are definitively not going to see jet fuel demand for a very long period of time. And the case can be made that we've seen peak jet fuel demand. And that case can be made for three reasons, basically. One is that jet freight demand is down, passenger demand is down, and we don't expect passenger use of planes to get to where it was in 2019 until 2022 or 2023. That's based on historical experience of demand downturns, including the financial crisis. Secondly, we're seeing a change in the efficiency of the jet engine. Inefficient jet aircraft are not going to be flying. We're not going to see as much jet fuel use waiting to take off as we've seen in 2019, 18, and 17. And that's going to be a big hit on demand. But the third one is that the industry at the IATA meetings in May reaffirmed their commitment to sustainable fuel standards. And that means more of a move to biofuels that do work as a substitute for jet fuel. So it may be that we've seen the peak of jet fuel demand in the world, and it will never get back to 2019 levels. We have to puzzle about gasoline demand. There are arguments on both sides of the notion of whether gasoline demand is going to resume or even grow on the basis of people not being willing to use mass transportation mechanisms. And there's arguments to be made that in this new world, there's an acceleration of telecommuting and remote working and other things that will reduce gasoline demand. But we think gasoline demand is going to be at a step level lower in terms of relationship to GDP when things get settled.
And indeed, I think this is what is really making headlines at the moment, is that fundamental shift in how people work and how they travel and what they do. And of course, all related, and we'll see how this plays out post-COVID. But I think people are having a long enough period to actually sit home and dwell on this and wonder, do they want to really put that commute into the office? It'll be interesting to see what happens.
And we have what you and I are doing right now.
Yeah.
So if we look at travel and we look at where the big payments are made to the airline industries, it's business travel.
It is.
We know that business travel is not going to be what it used to be because of this acceleration. You're using Zoom technology, but there are other virtual meeting technologies at work as well. And you're not going to need to do as much business travel, and companies are going to cut back on it for sure as they look at their own budget. So that's another factor to bear in mind.
Well, we hope we'll have meetings in person, and we hope I'll get to interview you again in person at an ADIPEC conference. So we'll keep an eye on all of the big conferences coming up. I don't want to lose them. But let's come back to a discussion quickly, just on the state of the economy. I mean, we're going to be looking at various things like travel and all of that, but industry is slowly coming back. And we're also, as you say, we're in a tough place right now. But what are your projections in terms of the hopes for the economy for the rest of the year? Or are we looking at a really tough recession? And when we also think about the fact we're just about to get the second quarter results, so the first half of the year over, the knock-on effect really, really going to be felt when we see those results coming out. It's not going to be a pretty sight.
No, but we're looking at labor statistics, labor market statistics that are looking much better than they looked a month ago. As I said earlier, it's going to be a bumpy ride along in this recovery. Just looking at the oil market, what's going to happen when we see Chinese demand falling by 2 million barrels a day? What is OPEC Plus going to do when they have their joint ministerial monitoring committee meeting in the middle of July? And what are they going to recommend for August? Are they going to bring 2 million barrels a day back? Are they going to postpone it? Bring it back too soon will be another hit on the energy sector for sure. And it is a very delicate balance. So I think it'll be bumpy, but we're relatively optimistic that the numbers will look big. And they'll look big on a year-on-year basis. Everybody's projection of 2021 growth against 2020 will be very high in the 5 to 6% range, bearing in mind that we're in negative territory through this year for most of the world economy. So I think by the winter, we're going to be seeing signs of optimism. And the unfortunate part of it is, I mentioned earlier, that we've lost 2 full years of oil demand growth. The world will have lost 2 full years of GDP growth. And it will be a long time before we see the prosperity that we saw going into 2019.
And I think it'll be tough for everybody, and it'll be particularly tough, I think, for emerging economies and developing economies that I think, we're doing particularly well around this time and really had a lot to look forward to. So hopefully, slowly but surely, it will come back. But when we look at policy, and we look at regulation, and we look at, indeed, the different relations, it's not just the US and China, it's the US and Japan, and the US and Europe. I mean, it's neither here nor there. How important is it that we get these trade talks back on track?
I think it's critically important. And yes, the US and the trade wars that were instituted right from the beginning of the Trump administration, but in particular in 2018, were problematic for the energy sector and the world economy. And, we kind of have a fear of the depression returning, and we have to remember that the highest tariffs in the world accompanied the Depression in the 1930s. This is a big concern. The world has actually seen trade shrinking since the summer of 2019. We're in a year-on-year negative world of trade for over a year. And that has hit demand for diesel in a particularly strong way. Diesel demand is hit because it's very trade related. Diesel demand is demand for trucks to move material to ports and from ports. And I'd say that a good 700,000 barrels a day of the demand already hit before the COVID epidemic started was diesel demand related to the shrinking global trade.
So Ed, another volatile and indeed very challenging year ahead. But remind us before we go in terms of your outlook and the pricing that you're looking at and the expectations. You're saying hopefully about 55 for Brent crude, 50 for WTI. Obviously a lot of work to be done in the next few months. But tell us, how are we going to get there?
So we get there through inventory draws and through demand growing. And the inventory draws will eventually get to the point where demand for crude oil will grow. I think if we look at what OPEC Plus has done, if we look at the curtailments of over 2 million barrels a day in the US and 1 million barrels a day in Canada, oil that's not going to come back in the market too quickly, we're going to be by August in a world where the demand for crude being produced will be higher than it currently is and higher combined with the inventory draw to bring prices up. Now, I talked about getting to 50 by the end of the year, getting to 60 by the end of 2021. That is the base case that we're looking at. But things could be on one or the other side of that. We have to remember that there are producers in the world, including in the Middle East, that can't pay their bills and that have no borrowing capacity. One of them happens to be Iraq, where there are governance problems. So we are in a period of time like we were in 1998, 99, when, as I recall, you and I might have had discussions about how is the world going to ever get out of this big inventory build that took place in 1998.
Yes.
Sure enough, by 1999, that inventory had been drawn down. And I think that'll happen. But other things happened in 1998, 99. 4 countries in 1998, 99, namely Venezuela, Nigeria, Iran, and Iraq, projected that collectively they were going to be increasing production 1 million barrels a day per year for 10 years. And 5 years later, when oil prices started going up, those 4 countries were producing less, a lot less than they were producing in 1998. And that's because of what happens to internal dynamics in petrostates when the price of oil is too low for too long. So we could see an even higher price, which would be kind of an ugly one in terms of whatever petrostates are seeing they're going down the route that Libya and Venezuela have gone down. There's the other part of it, and that is the uncertainty about whether there's a vaccine, uncertainty about whether there's going to be a sustained, not just recession, but depression. And prices could not, in one case, they could not be at 60, but at 75. And that would be a boom to the producers that can flourish at that level. The other side of it is the possibility of a recession being prolonged and seeing even lower prices in 2021 than in 2020. And it's that fear, of course, that keeps the OPEC Plus countries together with the US on the same page and on the same focus.
So many variables there. When we look at what producers have to contend to in the next few months, it's certainly not going to be easy. But indeed, they've looked at these challenges before, and I know they're very, very carefully looking at them once again. So I just want to thank you, Ed Morse, the Managing Director and Global Head of Commodities Research for Citi. Thank you so much for your expertise, for your time, for your effort, for your energy, for your great knowledge and sharing with us here at ADIPEC Energy Dialogues. Ed Morse, thank you so much. We're delighted you've joined us.
Thank you, and I look forward to seeing you in the flesh at the next ADIPEC meeting.
Yes, indeed, Ed. We're all going to be really looking forward to meeting up in person again. But once again, thank you so much for taking this time from all of us at the ADIPEC Energy Dialogues. A big thanks to you. And for all of you watching, keep an eye. We will have plenty more conversation in the months to come to keep you up to date. I'm Ethna Trainer. Thanks so much for watching.